This is Nick Perry with Schaefer's Investment Research, and today I want to talk about exchange-traded funds. I want to offer a brief introduction to ETFs and quickly touch on some of the uses. This is meant as a quick primer for those who may not be familiar with this trading vehicle. At the most basic level, you can think of an ETF as a basket of stocks. What you're seeing on the screen is just sort of a rough example. Basically, one ETF share corresponds to 43 shares of this stock, 37 shares of this stock, 3 shares of this one, and down the line. So basically, it allows you with one purchase to get exposure to a number of different stocks. The advantage of exchange-traded funds is that they trade like a stock, and that they trade all day long. You can buy them, you can sell them, you can short them, you can trade them on margin, but they offer the diversification like a mutual fund. As we saw on the slide before, one ETF share equals a set number of different stocks, which means that you get some diversification there. So you can buy one share as opposed to having to go out in the market and buy a number of different stocks. Perhaps one of the more confusing aspects of ETFs is that there are a number of different families, different types of funds. When you start looking at them, you're probably already familiar with some of the more popular ones like the NASDAQ 100 Trust, the QQQQ, or the SPY, which tracks the S&P 500. Those are sort of broad market funds, but there's a number of different financial firms that offer different families. You may see some that are branded as iShares, some branded as Power Shares, Street Tracks, Select Sector Spiders, and Holders. And I've sort of changed the color on Holders, noted them, because some people classify Holders as not a true ETF. There is a slight distinction with Holders versus everything else, and I'll get to that in a minute. But for the most part, I sort of lump them in the same category. As far as what are the differences between these families, with the exception of the Holders, they pretty much all act the same. They trade just like a stock does. It's basically they're made up of different component stocks. So, and there'll be overlap. So, for example, iShares, Power Shares, and Holders may all offer a biotech fund. But when you look into the performance, you'll see that they vary, and that's going to come down to the fact that they hold different stocks. The distinction with the Holders is that they only trade in 100 share lots, meaning you can't just go out and buy one share like you can for the other ones. You have to buy them in 100 round lots, which just means you have to put up more capital. So if you're looking to build a portfolio with with a variety of ETFs, the Holders, you may not have the capital to use the Holders. If you're trading options, that doesn't have an impact on you. You can still trade options on the Holders like you can the other ETFs or like stocks. And the only other note I would make on the Holders is that they don't tend to get rebalanced. The other ETFs, they will track set indices, and those indices are rebalanced quarterly, annually, semi-annually, and it allows the ETFs to sort of re-weight the stocks in there. Holders don't have that process. They're sort of set from their inception date. So the only way they really change is through corporate actions. One company buys another one. That can lead to some skews in these where some stocks are very heavily weighted. An example of the Holders you may want to look at is the biotech holder. Its symbol is BBH. Genentech carries a very high weighting in this, and that can be sort of a potential liability if you're looking for diversification, given that Genentech's going to dominate the action of that ETF. So if you're looking for diversification, the Holders you may want to shy away from those. At least some of them. Go ahead and if you go to do some research on them, you can find out what the weightings are, and it may be okay with you. But if you're looking for something that's heavily weighted towards Genentech, then that would be something you might be interested in. As I sort of just touched on, exchange-traded funds can track a number of different areas. Some are designed to track the broad market. Examples of these would be the SPY or the QQQ. The SPY tracks the S&P 500. The QQQQ tracks the NASDAQ 100. The IWM tracks the Russell 2000. The DIA tracks the Dow Jones Industrial Average. There's also sector funds. I've already touched on the BBH. the IBB, which are biotech sector funds. There are now ETFs that track commodities. The GLD and the IAU track the gold, track gold itself. And there's also ETFs that track foreign markets. So if, for example, you want exposure to an overseas market, you can get that with these ETFs. So basically, if you're looking to trade a group, a sector, a particular market, ETFs offer the advantage that you can do it with just one purchase. The uses of exchange traded funds are as varied as the individual investor. I mean, they offer a lot of different uses. That you can use them for hedging, speculating, just pure investments. They offer a lot of potential. Primarily, what I'm doing with them, if you read my weekly ETF column that I post on our website, basically, I track a set number of ETFs primarily as a way to gauge momentum. I track the leading and the lagging ETFs, and this gives me a feel for where money is flowing. What groups did well this week, what groups are doing well the previous 6 months, during the past year. It basically allows me to see where money is flowing to and where it's flowing away from. And this leads to the second point, which is it can spur idea generation. And by that, I mean if I see that the oil services sector is breaking down, is lagging the market, I can dig into that and potentially find stocks that I may want to look to be cautious on. It also leads to strength, where if you see a group leading, it may say, okay, software is leading, and then I can dig into that and find stocks that are outpacing the index, or maybe stocks that are looking to play catch up. Like I said, it's a way to sort of get in touch with what's moving in the market. So that's how I use ETFs. That's definitely not how everyone's going to use them. It's not how everyone should use them. ETFs are not going to be right for some people. There's been a lot of talk about how there's just been this proliferation of ETFs, and some people are saying there's too many, that people are going to get overwhelmed, that it's sort of muddying up the market, and that I can see the reasons for that. I tend to be of the camp that the more options you have, the better. Investing is about making decisions. It's about research, and the more options that you have, the different areas that you can go to, I think only helps the individual investor. But like I said, they're definitely not for everyone. They do offer certain advantages. The one thing I didn't touch on is that you do pay commissions like a stock. So unlike a mutual fund, where you may want to keep adding to it, there's going to be a cost involved with that. So if you are looking to sort of add here and there, that's definitely something to keep in mind. So that wraps up my thoughts. Like I said, this was just a general introduction to ETFs. If you're looking for more information on ETFs, we have an ETF center on our website. You can find some information there. The exchanges have information. The Amex has a good, on the Amex website, they've got a good section where they give some information about ETFs. And you can also find information at the families. For example, the iShares website is a great tool for digging into the iShares. It offers what stocks are held, the different ETFs they offer. So that's where I would recommend starting your research.